Hello everyone, thank you for joining me today. Sasan Mirkarimi here with Equity Legal LLP. Today we're going to be talking about whether you really can stop making mortgage payments. This video is designed for anybody that is thinking about or is concerned about whether or not they can make their mortgage payments during this difficult financial crisis. If you are considering not paying your mortgage payment, there are three things you really need to know. Number one, what kind of lender or servicer do you have? Number two, are there really any foreclosure moratoriums? And number three, have you confirmed with your lender how they will treat the missed payments? Number one, what kind of lender or servicer do you have? This is a very important question to understand because you really need to know the type of servicer and the type of loan that you have. Because the protections that everyone's been talking about in the media, those are mostly applicable to federally backed mortgage loans. So why is this important? Because as you know, on March 27, 2020, President Trump signed into law the CARES Act, also known as the Coronavirus Aid, Relief, and Economic Security Act. This was the major stimulus package that was initially, presented by Congress, and it was meant to provide financial relief across the board, but a big component of that actually affects mortgage loans, mortgage payments, and foreclosure moratoriums. Specifically, the law provides financial protections to homeowners who have been negatively impacted as a result of the COVID-19 situation. And again, the important caveat that's missed in all this is that the protections are only provided to those borrowers that have loans that are backed by federal agencies like Fannie Mae and Freddie Mac. And that's important to you because it may not be clear, and if you don't know what kind of lender you have, you might stop paying your mortgage payment and be stuck in a situation where you don't get the protections that were provided under the CARES Act. So what is the CARES Act? This allowed borrowers with loans backed by the federal government to withhold payments and defer interest for a period of 6 months. And also, during that 6-month period, they also prevented, lenders or servicers from initiating foreclosure activity. Now, this is important because other borrowers that don't have federally backed loans don't necessarily have the same, relief offered to them. And, while they've been offered forbearances or deferred parent payments, it does not necessarily mean you get it for that, 180-day period, or that, you're basically going to have it interest-free for that period. So let's talk about foreclosure moratoriums. What is a moratorium? The moratorium is actually intended to completely halt foreclosure or eviction proceedings during this difficult economic time. We've had them before in the last financial crisis, and it's important to understand whether that's just a catch-all, you can't foreclose, or are there differences? And the tricky part is there are differences, and it depends on whether you have a federally backed mortgage loan, like we discussed earlier. Under the CARES Act, there's a foreclosure moratorium that prevents borrowers that have federally backed mortgage loans from pursuing foreclosure activity for a period of 90 days. But on the state level, it could be different. And then on the local level, we have some municipalities that are even putting more restrictive moratoriums than provided under federal or state law. So it's important to understand how that affects you and understanding if that really can stop a foreclosure from going forward. The third and most important thing that I want you to take away today is what happens to your mortgage when you resume, or when this 30, 60, 90-day period that you were offered ends. This is a very important question, and it's not being clearly answered by the banks. It's important to get this in writing or get them to confirm what's going to happen either before or soon after you stop making mortgage payments. Because in the media, and even on some of the banks' websites initially when this all started, they had stated that forbearances or deferments, which are two different things, would be available to borrowers, and that's all they did, and people jumped on it. Well, everyone had the understanding that after the 60 or 90-day period, your outstanding mortgage amounts or the payments you missed would be tacked on to the back end of your loan, and you would resume normal payments. But that is not necessarily the case, and this is something you definitely must be aware of and have to be careful, because banks are not making the distinction, and they're two different things. A forbearance, for example, is when a bank forbears from collecting mortgage payments, but interest continues to accrue. A deferment, which is what is under the CARES Act, like we discussed, is when no interest accrues for that period that you're, withholding making the payments. And so you really need to be careful, because if you don't get the bank to confirm how they're going to treat it at the end of that period, you could be faced with a foreclosure situation, receiving a notice of default, when all along you could have made the mortgage payments, but you only took advantage of it because that's what was offered to you as you were suffering or concerned about this crazy financial crisis we're in right now. So it's important to get this stuff in writing, get them to confirm as much as possible what happens when we resume. Because already I've seen that, JP Morgan Chase, Wells Fargo come out with some stuff 2 months later that's saying that, once you resume, you're gonna have to pay the full amount of the mortgage payment that's owed. And that just can't be the case, and that's a problem. And so it's important, we're monitoring the situation, and I ask you to stay ahead of that and make sure you can get them to commit to how they're gonna treat it. An experienced attorney that understands how to work with mortgage servicers or how to navigate through mortgage loan-related loss mitigation options is crucial. It's important to be proactive, because in the 2008 financial crisis, homeowners were supposed to be provided modifications of their loans as a result of huge government bailouts provided to lenders. Unfortunately, that did not happen. For millions of people, they did not receive their loan modifications, and they ended up losing their homes to foreclosure, while the lenders still ended up getting huge bailout money from the government. An experienced attorney can help you stop or dramatically delay any wrongful foreclosure proceedings, initiated against you, and more importantly, can help you be proactive, because we've seen when an attorney is involved while a borrower is engaging in a loan modification or other loss mitigation option, you really can help move things along faster and get them escalated to a result for you. If you feel like your lender or mortgage servicer has not given you this type of clarity as to what's going to happen with any missed mortgage payments after the 60, 90-day period, or if you don't understand what kind of loan you have, or really you're just very anxious and nervous as to what's going to happen to your property when this all subsides, I really invite you to reach out to us. We are offering what's called a 20-minute complimentary mortgage consultation. During this consultation, we will help you navigate a lot of these important questions that we've raised today during a very difficult time for you. I appreciate you joining me today. Thank you very much, and have a great day.